Okay, I want to do a very quick video on how to read charts. Um, in the previous video, we walked you through how to set them up. Now we are going to learn how to read them. I'm going to make this video very brief because I've been trying to make them, and they all turn out to be like 40 minutes, and I know no one's going to watch that, so I'm going to try to keep it under 5. Um, so here we have Bollinger Bands. That is these green lines. When you see the range narrowing as it's doing here, it's bouncing between a very small range in price. It's going from like say 85 to 90. It's consolidated. This is the opposite of consolidation. This is just crazy. It's all over the map. What we want to see is a tighter range. When the stock price starts to narrow like this, it indicates a breakout is coming. Now, indications are only as good as everything else aligning perfectly. In other words, the earnings have to be good, the sector news has to be good, the broader economic news has to be good, the chart has to be setting up perfectly. And the thing about charts is, if everyone is using them, it's an indicator that they do work, right? So a lot of people say, well, charts don't really work, or they only work until they don't work, which is kind of stupid. Like everything works until it doesn't work. My car works until it doesn't. If everyone is following these charts and everything else lines up perfectly, it does indicate that it potentially could move higher. It won't every time. They're not 100% accurate. All charts do is allow us to take a random guess and turn it into an educated guess. And we can do that by looking at charts and then confirming through Bollinger Bands, and then reconfirming with the standard moving averages, and then finally reconfirming the reconfirmation, so confirming 3 times by looking at the RSI. If all 3 line up and match, you've got yourself a potentially good trade. Now, don't buy this stock. I don't own this stock. I've never bought this stock. I'm just using it because it's a prime example of a good breakout. Crosses over this top line, and look what happens. It goes from around 92 all the way up to 137. Now, what you have to do as a trader is you have to have in mind where you hope the stock goes realistically, right? You're buying the stock at 92. You're not thinking, I know for a fact in 2 weeks it will be 137 and that's where I will exit. But if it has a tight range of around $10, it's possible that this stock could move another 10. So you do the math, you figure it out, you go, okay, I'd be happy with taking a $10 per share increase. When it gets to around 100 or 110, we'll see how it goes. I'll exit the position. Now you see that it starts to move higher. You can do 2 things. You can get back in, or you can wait for it to establish a new trading range, which it looks like it's doing over here. Since we don't know how far a stock is going to move, you could buy it at 80, sell it at 110 or even 120, and then watch it go all the way up to almost 140, and you'd be pretty pissed. But if you chase, look what happens. Say on this day you go, you know what, it broke out again up here, I'm getting in, and you buy in at 137, and then the next day it drops to 116, and you wipe out some of your profits. That sucks. So the best thing to do is come up with a profit you'd be happy with, take it, and then wait for it to establish a new trading range, which it looks like it's going to start to do over here. It's probably going to bounce between the $110 and $100 a share range until it starts to look like this again. And then we'll start paying attention to the company news, the sector news, the broader economic news. We'll look at the earnings and make sure everything sets up to look like a good trade. And then we also want to come down, and also we want to look at these moving averages, right? This is the 200-day moving average. It's well above that. So now we want to get a more narrow idea, and we want to start looking at 50 and 10. And it's trading above those as well. But then over here, it crosses. Now this is an example of it not working. See how it crosses down here? This is an indicator to sell. It's breaking out to the downside, which means that it has potential to go lower. But instead of actually dropping, it kind of just levels off. It's going to establish a new trading range here. Now we want to go down here and we want to look at this residual relative strength index. Anytime this green line crosses over this gray box over here that says overbought, it means that the stock is overrun. It's had a good run and it's due for a pullback. You can see it, you can confirm it, right? So it crosses over here. This is an indicator that we want to get in, right? Because it crosses over this top Bollinger Band. Now we go down here and we go, yep, it is entering oversold territory. I'm not going to be able to hold the stock for very long because it will pull back. You get in, you get out, and you wait. And look what ends up happening. This confirms it. Boom, it drops. It's no longer overbought. It means it could level off here. The opposite is down here, oversold. If it crosses oversold territory, it's a buying signal. It's saying too many people have dumped this stock. It might be time for a turnaround. The last thing I want to show you is up here is the 1 month and the 3 month. See, stock traders don't really care about what happened 10 years ago, right? We want to know the here and the now. I'm more interested in what happened within the last month to 3 months. Where is the stock going? Where is it going to go? A lot of people say you can't time markets and that patterns are bullshit. But if I'm using these charts and I see this as a buying opportunity and then I go in and I buy, and you are also doing the same thing, and everyone else who trades stocks is also looking at these charts, it's an indicator that it likely could move up. But a lot of factors play into that, like earnings. Here's another one, for example. It breaks out right here, but then it starts to drop. So we would say, well, why is it dropping? What's going on? And we would go up here and we would click on summary, and we would go down here to where it has events, and we would see, oh, in a week or so, they're coming out with their earnings report. And this company has had historically pretty bad earnings. How do I know that? Let's go back at a longer chart. Look, every time an earnings comes out, it seems to drop lower, right? Here it's all pretty good. Bad earnings, boom. Bad earnings, boom. Bad earnings, boom. But now it's starting to turn around. So, but that doesn't really matter. Still, people are still a little anxious going into earnings, and that's why it sells off, even though it's broken out. This is an indicator it's heading higher, but nope, because something is making people nervous. Here's another example of a chart not always working. It's Apple. You can see it's over every moving average. It's edging ever so close to a breakout. Earnings are coming, and it's Apple. They have consistently good earnings. It breaks out to the upside. We look over here. It is heading into overbought territory, which means it's a potentially good trade. Earnings come out. Stock skyrockets from 210 to 221. But then what happens? Extenuating circumstances, something beyond the control of good chart, good sector, good earnings. And that happens to be, this red candlestick happens to be President Donald Trump saying, oh, believe me, these tariffs. And the second he tweeted about more tariffs on China, look what happens. The stock plummets. That's why you want to protect your capital. That's why you want to use stop losses within a $2 to $3 range. So when you buy Apple at 221 and it starts dropping, you don't end up buying it at 221 and then watching it drop to 206 to 201 to 192. Imagine being the poor guy who bought it here and held it all the way down there. Now you've got a loss. Now it's Apple. It will likely turn around. It will likely come back. But still, you want to be using, we're not investing in the long term. We're trading. I need that capital. I need that money. If I put in 100 shares in Apple, that's $22,000 here, and now I've got $19,000. I need that money to trade. So that's why you want to use a stop loss and say, hey, I'm going to take a $200 loss, even though it's Apple. I'm going to get my money back so I can keep trading with other things. So that's how you read charts. I hope this video was helpful. I will do longer videos and more in-depth videos, but this is an introduction to charts and how to read them. And I didn't want to overwhelm you with boring stuff. Please like, please subscribe, and have a great day.